We copy and paste a part of the balance sheet just to keep the cell format consistent. The cash flow statement divides the cash flow within the period into three categories. The first category is cash flow from operations. It includes cash inflow and outflow from running its day-to-day activities. Revenue, expenses, funding of the net working capital are included in this category. Revenue and expenses are first assumed to be all cash inflow and outflow, hence the net income is assumed to be identical to the cash flow, or the cash movement during the period. Following the net income, its non-cash components such as depreciation and amortization are added back to match the actual cash flow. Funding working capital is not included in net income, hence included separately. The second category is the cash flow from investment. This shows how much the company has spent on investment. CapEx, merger and acquisition, purchase of marketable securities are all cash flow under this category. On the other hand, proceeds from sales of fixed assets, divestment of business are examples of cash inflow from the company's investment activities. We can summarize the cash flow from investment activity as the cash flow associated with sales or purchase of the bottom left part of the balance sheet. The third category is the cash flow from financing activities. It relates to debt and equity financing that is used to finance its business. Borrowing money or issuing equity security is cash inflow from financing activities. Repayment of debt, return of capital to shareholders, payment of dividend are all examples of cash outflow from financing activities. In principle, cash flow relating to the bottom right part of the balance sheet are cash flow from financing activities. We should note that from finance and valuation perspective, interest expense should be classified as part of cash outflow of financing activities. According to IFRS, it can be recorded in either cash flow from operations or investments, whereas under US GAAP, it is reported under operating activities. Now we have cash flow from operations, investment, and financing. The total cash flow is the sum of these three. Once we calculate the total cash flow of the period, we can calculate the ending balance of the cash. By definition, cash balance at the beginning of the period plus total cash flow equals cash at the end of the period. Also, cash balance at the beginning of the period equals the cash balance at the end of the previous period. In the spreadsheet we often calculate the beginning balance plus movements in the period equals the ending balance. Sometimes it is called corkscrew, as it looks like a corkscrew. To summarize, we classify the cash flow into three activities: cash flow from operations, cash flow from investments, and cash flow from financing activities. We add them all up and we get the total cash flow during the period. Finally, we calculate the ending cash balance. This calculation component within the financial model of taking the beginning balance, add the movements in the period and come up with the ending balance is called corkscrew.